Good evening to each and everyone present here. Today we are going to discuss about risk management. So, this risk management in the stock market refers to the strategies and techniques investors use to minimize potential losses and safeguard their profits. We can think of this risk management as a safety net designed to protect our hard-earned investments. By applying proper risk management, traders and investors can navigate the unpredictable nature of the stock market with more confidence and consistency. So, first of all, what is risk management? In simple terms, risk management is the process of identifying, assessing, and mitigating the potential risk associated with investing in the stock market. It involves setting clear rules and boundaries to ensure that losses are limited and you don't make impulsive decisions during volatile market conditions. Just as a seat belt protects you in a car, risk management protects your investments from severe damage during market downturns. And why does this risk management matters? Limits losses. Without a proper plan, a single bad trade or market downturn can lead to significant losses. Risk management helps you define how much you are willing to lose on any single trade or investment. For example, setting stop loss orders ensures that if the stock price falls to a predetermined level, you automatically exit the trade, which leads to minimizing the losses. Like, for example, imagine you buy 100 shares of a stock at $500 with an expectation that the price will rise to $600. However, to protect myself from unexpected market downturns, I will set a stop loss order at $450. If the stock price drops to $450, my stop loss triggers and the shares are sold automatically. This limits my maximum loss to $50. Without this, if the stock crashes, my loss could balloon to whole $500. Reduces emotional trading. Here, fear and greed are powerful emotions that often drive irrational trading decisions. When you have a solid risk management plan in place, it acts as a guideline to prevent emotional reactions such as panic selling during market drops or overbuying during uh, market rallies. Like, for example, if I invest 5,000 dollars in a stock, expecting a 20% return, I will also set a target profit of $6,000 and a stop loss at $4,500. So here, if my stock hits $6,000, I will sell and lock in my profits. And if it drops to $4,500, I exit to prevent further loss. So this pre-planned approach ensures I stick to my strategy, avoiding emotional decisions like holding onto a losing stock, hoping it will rebound, or becoming greedy and not selling at your target. Protects your capital. Trading capital is the foundation of success in the stock market. Risk management ensures that your capital is not wiped out by unexpected events or poor decisions. Protecting your capital allows you to continue trading and investing in the future even after facing occasional losses. Ensures consistency. Consistency is key to long-term success in the stock market. Risk management helps you follow a systematic approach rather than gambling or making unpredictable moves. By maintaining discipline, you can build steady and reliable returns over time. Increase long term success. Investing in the stock market is a marathon, not a sprint. The primary goal is to grow your portfolio steadily over the years. With risk management, you avoid losses that can set you back significantly. Ensure that you stay on track to achieve your success. Like here at the end of the day, what happens is in the stock market, there is nothing like, okay, even there is a very positive news, there may be a chance of falling, the stock may fall at that time. So here in a game, this stock market is a like a game, like a war between two people. The people who believe in calls is one, and the people who believe in put is other side. So it's just a war between, in a word, this stock market, this trading or investment is a war between the people who are in call side and the people who are in put side. So just uh, any of these, any of them can win. So at such times, what we need to do is, it's very essential to determine a plan before we started investing, like setting stop loss orders and setting our targets before starting investing. Because we, at the end of the day, we don't know who can win between these two. So here there are some risk management strategies. Set a stop loss. I mean, a stop loss is a predetermined price level at which you will exit a trade to minimize losses. It helps protect you from emotional decisions and significant financial damage. Like, for example, if you purchase a stock at $500 and set a stop loss at $450, the trade will close automatically if the price drops to $450, capping your loss at $50. Stop loss orders are particularly useful during volatile market conditions when prices can change rapidly. Determine your risk tolerance. Risk tolerance is your ability.
That's what it's available.
Yeah. Uh, risk tolerance is your ability and willingness to endure financial losses. It depends on factors like financial situation, investment goals, time horizon, emotional response to risk. For example, if you are nearing retirement, you may you may prefer low risk investments. On the other hand, younger investors might tolerate higher risk with growth oriented stocks. Understanding the risk tolerance ensures that your strategy aligns with your financial goals and comfort level. Exit strategy. An exit strategy defines when and how you will close a position, whether to lock in profits or cut losses. It's critical for maintaining discipline. I mean, we need to decide a price at which you will sell and secure gains. For instance, if you buy a stock at $100 and you may plan to sell it at $120 for profit or exit at $90 if the price falls. This pre-planned approach eliminates impulsive decisions during market fluctuations. Long-term market survival. So here, small losses over big ones. It means we need to focus, I mean, we need to small control the losses are part of trading. and it can be managed through tools like stop loss orders or position sizing. A single large loss, however, can wipe out months of gains. So, by keeping losses small, we can preserve our capital for future opportunities. Consistency over time. I mean, the stock market rewards disciplined and consistent traders. Even small, steady profits compound over time. Like, for example, a 1% return per month might seem small, but it translates to over 12% annually, outperforming many market averages. And we need to avoid chasing big wins or relying on luck. Rather than we need to focus on developing a repeatable data-driven process, learning from losses. Losses are inevitable, but each one is an opportunity to improve. After every losing trade, analyze what went wrong. Was it a poor entry point, or did we ignore stop loss, or were any emotions involved? Like, for example, if you lost money because of holding onto a losing stock, you might adjust by implementing strict exit rules in the future. Capital preservation versus profit generation. So here, capital preservation is about safeguarding your money so you can continue trading and investing over the long term. It's your top priority in the risk management. So in here, our top priority should be we need to preserve our capital. When we preserve our capital, then we can focus on generating the profit. But here the top priority should be on preserving our capital. Here again, small losses are better than big ones. I mean, here, uh, losing small amounts allows you to stay in the market and recover with future trades. I mean, even if the losses are small now, I mean, instead of getting disappointed, instead of getting frustrated, I mean, with consistency, we can make a big ones, big profit trades over time, and consistency over time. Like by protecting your capital, you can avoid large drawdowns that can derail your financial goals. Learning from losses. Protecting capital gives you the ability to learn and improve without depleting your resources. Profit generation. Profit generation involves growing your money by making successful trades. While it's the ultimate goal, focusing on profits without preserving capital can lead to disaster. For example, if you take high risk to chase profits but lose a significant portion of your capital, you may not have enough funds left to continue trading. I mean, here we need to prioritize protecting your initial investment before aiming for higher returns. Risk calculation and management. Here, maximum potential loss. Before entering any trade, it's essential to determine the worst case scenario. How much money you could lose if the trade goes against you. And how to calculate this? I mean, we need to identify our total investment in the stock, decide on the percentage of your portfolio you are willing to risk on the trade, like for example, 1%, 2%. Factor in the stop loss level to calculate the potential monetary loss. Like for example, if I buy 100 shares of a stock at $20 per share, investing 2000 in total. Here I decide I am willing to risk 2% of my portfolio. So if my stop loss set at $19, my maximum potential loss is So first of all $20. So here what happened is I had purchased 100 shares, for example, 100 shares at $20 per share. So investing $2,000 in total. In the $2,000 in total, I am willing to risk 2%. I am willing to risk 2%. So here my potential loss will sit at $1,800. I mean, when I'm willing to risk 2%, yeah, it will $1960. So this ensures that even if the trade fails, my loss will be limited to $1960. So so here in this way, okay, so in a word, it is like, okay, I need to decide, okay, what is my total investment in the stock, and in the total investment, how much percentage I am willing to risk, so that can be my maximum potential loss. So stock price volatility. Stock price volatility refers to the extent of price fluctuations over a period of time. Understanding a stock's volatility helps you assess how risky it is to trade and set realistic stop loss levels. So again, how to analyze this volatility? I mean, we need to review the stock's historical price, movements like charts, indicators. I mean, in there are two indicators which are like average true range and average day range, ADR and ATR, and these two indicators will tell about the stock price volatility. So stock price volatility in the sense, let's see practically here. Yeah, so here let's see the I mean, how to assess the stock volatility in the sense, let's say any stock, like for example, AMD here, AMD stock in the is there. For this AMD stock, there are uh, two indicators, average day range. Average day range is one indicator, and average true range is another indicator. So these two indicators indicates what is the stock volatility of a stock. Like for example here, like I can say AMD here. Here we can check here we can check the stock volatility. So at present the stock volatility is around $5 per day, $5 per day. but previously there was like $7, $6. So now uh, by seeing these two indicators, I can decide like, okay, there is price volatility of $5, at least $5. So now according to this, if I need to set my target, okay, if I need to set my target, I need to set my target at, I mean, let's say I'm investing at $118. Okay, I'm believing, okay, it will go up now. So I'm investing at $118. So I need to set my target at some $128 level, $128 or $138 level. So, and my stop loss should be at uh, one not $105. Yeah, $105 or at $100. It's because the price volatility is around $5 at this moment. So even though okay, it's like you have to decide it will fall $5 at any cost. Okay, if I am investing in this stock now, it's it will fall $5. Okay, it will $5 at any, I mean, it will fall $5. So it will fall $5. This AMD stock will fall $5 at any cost. Even if it goes up, even if it goes down, even if it goes up and even if it goes down, it will fall $5 at any cost. So now, if I am going to invest in AMD stock, I need to decide myself beforehand that my stop loss should be at least $10. I mean, beyond $10, because it will fall any, I mean, in it, I mean, it will fall anyhow $5. So my stop loss should be at around $108, $103 or $98 at those levels. Whereas my target should be again, it should be again a $128, $138. So in that way. So here, uh, here again, again here stock price volatility. Here stock price volatility once means how we can analyze the volatility means first we need to understand the what is the average day range of a stock, what is the average true range of a stock. First we need to understand that. Okay, after analyzing that, then we need to set our stop loss orders, and then we need to set our targets. So without knowing the volatility of a stock, so it will be somewhat problem. I mean, it will be again, it will again lead to, eventually leads to losses. So stop loss placement. So a stop loss is a key tool for limiting losses. It automatically exits our position if the stock price reaches a predefined level, ensuring you don't hold on to losing trades longer than necessary. How to place a stop loss? We need to analyze support and resistance levels. So stop loss in the sense, how should we place a stop loss? So before placing a stop loss, we need to analyze support and resistance levels. So I mean, we need to place the stop loss slightly below a key support level or above a resistance level. I mean, or we can decide the percentage of loss I am willing to tolerate. So, for example, if I buy a stock at $500, the strong support is at $480. So, I need to place my stop loss below this level, like for example, at $475, which allows some room to move without exiting prematurely. So, risk per trade, percentage of portfolio. Here, risking a specific percentage of our portfolio on each trade ensures that No single trade causes significant damage to our overall capital. This approach is especially important in volatile markets. Here, we need to decide on the percentage of my portfolio which we are comfortable risking per trade. And then we need to calculate the maximum dollar amount we are willing to lose on a trade. So finally, we can use this calculation to determine our position size and where to place our stop loss. Like for example, if my portfolio value is $10,000 and my risk per trade is 1 to 2%, like $100 to $200. So if I buy a stock at $50, then I need to set my stop loss at $48. I mean, I am willing to risk $2 per trade. So stop loss at $48, limiting my loss to $2 per share. So here, by using this strategy, even if the trade goes against you, my loss is capped at $200. My loss is capped at $200. So here again, in the example mentioned here, if I have a $10,000 portfolio and I use the 1% rule, I'm willing to risk $100 on a trade. So if my stock price falls to my stop loss point, I will lose no more than $100. So using risk reward ratios. So this risk reward ratio evaluates whether a trade's potential profit justifies the risk involved. A favorable ratio helps you to make trades that are statistically more likely to yield positive results over time. Here, what we aim for is a risk reward of 1 is to 2 or higher. I mean, here for every $1 you risk, aim to make $2 in profit. Again, higher ratios like 1 is to 3 or 1 is to 4, it will be very helpful in the long term investment. So, how to calculate this risk reward ratio? First, determine potential loss. So the difference between my entry price and stop loss price. Like for example, if I buy a stock at $100 and if I set a stop loss at $95, my potential loss is $5 per share. Determine potential profit. So the difference between my entry price and target price. Like if my target price is $110, so here my potential profit is $10 per share. So calculate the, again divide the potential profit by potential loss. So here what happened? I had purchased a stock at $100 and I set a stop loss at $95. Means here my stop loss potential loss is $5. And again my target is $110. So I had purchased at $100 and my target is $110. So again here my target is $10. Here I am willing to risk $5 and my target is $10. So here divide the potential profit by potential loss. So when I divide the $10 by $5, I will get a 2 is to 1. So again 1 is to 2 ratio. Here, I mean, here for every $1 I am risking, I am aiming to make $2 of profit. So here 1 is to 2 is the ratio. So again, here the trade, I mean here aiming for $2 of return for every $1 I risk, making it a favorable setup. So again, uh, uh, again, let's say if it is for long-term investment, I aim from 1 is to 3 ratio or 1 is to 4 ratio. In the sense, for every $1 I am risking, I'm willing to make $3 per share or $4 per share. So for the long term investment. So again, this gives me the uh, this gives the risk reward ratio. And risk management and stop loss management. Risk position sizing and stop loss management. So what is this position sizing? Position sizing refers to determining how much capital to allocate to a single trade based on the risk you are willing to take. The goal is to ensure that even if a trade goes against you, the loss is manageable. How to calculate this position size? Decide on the total amount you are willing to risk. Usually, it is 1 to 2%. So risk, so here position size, it have a formula like total amount at risk divided by risk per share. Like for example, if I am investing $500 on a stock, on any stock, I am investing $500 and I am willing to risk 1% of my of I mean 1 to 2%, like let's say 2%, then I'm willing to risk $10 on that. So here my stop loss will be at $490 and my risk per share will be $10. So here in this way, by calculating the position size, I can ensure that my maximum loss does not exceed $10, no matter how the market moves. Stop loss orders. Again, it had discussed again. A stop loss order is a powerful tool that helps limit potential losses by automatically exiting a trade when the stock prices reaches a predetermined level. So again, in the stop loss, we have two stop loss orders, like fixed stop loss orders. Like for example, if I buy a stock at $100, then a fixed stop loss at $95 will exit the trade if the price drops to $95. And the second is trailing stop loss orders. So in this trailing stop loss order, here we can adjust dynamically as the stock price moves in your favor, locking in profits while protecting against downside risk. Like for example, a trailing stop loss is set 5% below the current market price and the stock rises to $110, then the stop loss moves up to $105. Like again, as the stock moves, we can adjust our stop loss according to that. Setting executive stop losses, like types of stop losses. Again, uh, I mean here, so here what means, to make stop loss orders work effectively, it's essential to place them thoughtfully. Like first of all, we need to avoid setting it too tight. Like if the stop loss is too close to the entry price, minor fluctuations in price may trigger it unnecessarily. Like placing a stop loss $1 below entry for a stock with daily fluctuations of at least $2 to $3 can result in premature exit. And avoid setting it too loose. I mean, a stop loss that's too far from the entry price increases potential losses. Like if I buy a stock at $100 and set a stop loss at $80, here I'm risking a very huge amount of $220. So, so here what's the intention is, before setting the stop loss, we need to prevent setting the stop loss too tight or too loose. So how can we determine where the stop loss should be? By we need to use technical levels. Like we can place stop loss orders at key support levels or key resistance levels or any EMAs, yeah, any EMAs. Like for example, if a stock has strong support at $95, I can set my stop loss at $93 or $94. Or if there is any 200 EMA at that point, or any 50 EMA at that point, then I can place it below, slightly below those EMAs. So portfolio diversification. So diversification reduces overall risk by spreading your investments across various asset classes, industries, or sectors. This minimizes the impact of poor performance in any single investment. So here, how to diversify effectively means we need to invest in different asset classes, like different sectors, like some in stocks, some in bonds, some in gold, some in real estate, and we need to allocate funds across multiple industries. Like we need to allocate in sectors, like we need to invest some in healthcare sector, and some in technology sector, and some in finance sector. So by this, and again, we can also invest in currency, where international exposure, due to the international exposure, we can benefit from global market trends. Like in the sense, in currency, uh, like in huge, if there is huge amount, then just by transferring the currency in country to country, we can gain profits. So, so do anyone have any doubts on?